Hey everyone, in today's video, I'm going to go through some of the recent moves I've been making in my $213,000 stock portfolio here. Now, I'm not going to go stock by stock into every stock I hold in this portfolio, but if you'd like to see that, I recently did that a few weeks ago. I'll link to that video in the bio of this video if you're interested in that. It's a really in-depth 50-minute video with, breaks in between that you can click to see what names you're interested in. But in this video, I'm just going to be talking about what I've been doing recently with my money and my positions, and we're just going to get right into it. As we get into it, if you like this type of content, be sure to subscribe to my channel. Consider liking this video too. It really does help out with the YouTube algorithm. First, just looking at the portfolio, super high level before getting into what I'm doing here. All time in my Canadian account, I'm up about 9%. In the last 1 year, up about 6% here. My US portfolio has done a lot better. In the last year, up 21%, all time up 20%. I don't think I've had this account for much over a year. In terms of what I'm doing with my portfolio, just scrolling through some of my stocks here to give you a feel if you're familiar with these tickers. If not, you can read the stock names under it. But I'm in a lot of REITs, in a lot of banks, royalty corporations, cover call ETFs I added to my portfolio recently. Lots of things that just give me passive income throughout my portfolio. I also own lots of food stocks. You see Restaurant Brands International there, Keg Royalty, A&W Royalty up here. Sorry, I'm scrolling around a lot. So have a ton of Canadian exposure. In this account specifically, I have about $145,000 in my Canadian accounts and then about 50,000 US dollars. So the majority of the money is in my Canadian account here. And that really is one of the main things you'll see in what I'm doing. But I'll talk about that later on. Right now, I'll talk about the first thing that I've been adding and focusing on in my portfolio. As the market's kind of gone up this year, rebounded a lot, I've been trying to be more disciplined, have a cash position on the sidelines. The thing is, I don't really want to have a huge cash position on the sidelines with interest rates at 5-6%. Just doesn't really make sense. I feel like I'm just losing money day by day. So this is kind of the tool or the security that I have been building up my cash position in. It's called the Horizons High Interest Savings ETF. Essentially, it holds your money in high interest savings accounts and pays you a dividend at the end of each month. You can see here, my goal recently was to get this one to about $15,000. Have recently done that. I think just here today, actually, I got this one up to $15,000. So that makes me kind of feel comfortable, have a bit of a $15,000 security just in case the market dips a lot. I wanted to free up some cash. I didn't have cash coming in that week or that month to invest. I have 15 grand just sitting here, and just on that $15,000 over the last couple of months of dividend payments, which I'll show you guys here in a minute. But I yield about $750 to $800 a year in interest just by holding that $15,000 here. So that's much better than holding it in a checking account or lots of other savings accounts. Looking into this ETF a bit, just giving you guys a bit more information. As of last week, this one had a yield of 5.4% in terms of the high interest that they were yielding for you that got paid out on a monthly basis. The monthly portion of that 5.4%. But there's a lot of investments out there that you can make less than 5.4% on in the year. It's a lot of cash accounts that pay you significantly less than that. So I feel like this, for me, is a good place to hold that money. I also like how I can hold that money in my Wealthsimple account. Makes it really easy to sell some, move it over to the USD account. You don't have to wait 2 or 3 days sometimes, like when you deposit new money to move it over. And then, unsurprisingly, you can kind of see over the last year, as interest rates were a bit lower than they were now, the 1-year performance is 4.3%. But this will essentially always be what the trailing interest rate yields are. It's already given you about 2.5% year to date. So this year will probably come in close to 5%. And just to let you visualize what these monthly dividends look like, you're on a $50 share, you're getting about 20 cents a month in distributions at these interest rates, a bit more than that. If I scroll down here, and this is actually a bit, looks a bit dated in terms of when the last update was. I think the more recent ones are actually 23, 24 cents a month. But you can kind of see they fluctuate month to month depending on what the interest rates are. This month was 22 and a half cents. This month was 20 cents. And I misspoke earlier. I was just looking from the top of 2023 to current day. So consistently the last few months, you've been getting 22, 21, 22 cents a share in dividends just from holding cash. So I try not to make this a huge part of the portfolio for obvious reasons. I want to be invested in the market, but I feel like it makes sense given the market, the stock market over the last year is up pretty dramatically, especially in the U.S. Also, some sectors in Canada. So I just like the fact that out of my $213,000 of value, I do have 15 grand in cash, which is about 5, 6, 7% cash position that is making me still 60 odd bucks a month in interest, which is great to have. So that's the first thing that I've been building up recently in my portfolio, less heavy on just flooding into equities left, right, and center, and being a bit more cognizant of ensuring I have a cash position for a rainy day in the market, or if I want to tap into it in the future in the market. So that's kind of the first place I've been investing my money recently in the last month or so. Moving over into my USD account, the other areas I've been investing my money in has been trying to globalize my portfolio a bit. So I've done this a couple different ways. The first way has been through bringing Coca-Cola into the portfolio. I think about 60 or 90 days ago, I did not own any Coca-Cola shares, but I did a lot of research. I felt like Coca-Cola was a really stable company, a company that over the long term will provide larger and larger dividends year in, year out. It'll be slow. I'm not going to get rich off of this stock, but I felt like it was a stock with limited downside, and I really loved lots of elements of their business model of having lots of royalty licensing fees coming from international markets and bottlers, and not having as high of a capital expense type business, a bit more asset light than some other CPG companies. And in addition to that, I love the globalized nature of this business, especially in Europe and in other countries in the world. They really operate all over the place. So I felt like that helped globalize my portfolio a bit. I'm really heavy in Canada. I do have a lot of money in US companies and the US stock market as well. So I felt making sure I picked a stock that had a global presence to add to the portfolio would have been the right thing to do. And as we look down at this stock, currently have almost 10,000 US dollars in it, 150 shares. It pays a starting yield. My average yield is about 3% on this one. And I think they're going to do about $2.60 a share. So trading about 24 times earnings, definitely not a cheap stock, but I feel like they have limited downside. Just one of those like safety stocks. I'll get my 3% dividend. I'll hopefully get, a 5-6% dividend increase a year to get that 3% to 3.2% and 3.5%, so on and so forth over time. So this was a bit of a safety net investment just to get another flow of income coming from a safe company that I felt like could grow over time. I can sleep well at night owning it, and I can put $10,000 in a stock that had more global exposure than the majority of my portfolio. Just looking at the dividend picture on this one to give you guys, once again, a visual of how this company's been able to compound their dividend over the years. In 1998, they were paying about 15 cents a quarter, and we just moved that up a few years. 2003, they were at 22 cents, 25 cents in 2004, 28 cents in 2005. So you see that high growth in dividend. But even as I get to more modern day, 2010, we're at 44 cents. And if I go up a couple years here, looks like they went from maybe they did some frequency changes to their dividend. But as I look here today, they are currently at 46 cents, and you can kind of see them jump 42 cents to 44 cents to 46 cents. So not huge growth in recent years, just like that 3-4% a year. But over the long term, that really compounds, and you can get to a point where you were getting, 20 cents a share, and now you're getting 44 cents a share. I think this is a bit skewed or challenging to follow, more challenging to follow than I anticipated because maybe some share splits throughout the periods as well. But I think this probably um, shows it better. You can kind of see the trailing 12 months dividend payout in terms of absolute dollars. And you go from 2003 in the bottom left hand corner, you can see that was 24 cents. And on a trailing 12-month basis, now they're paying out close to $2 a share. So from 25 cents to $1.78 over 20 years, that is about a 800% increase in the dividend. So I'm hoping that over the next 10, 20 years, I'll get the same effect, and my $2 dividend is closer to $10, $15 a share, which on my 150 shares would be a couple $1,000s a year just from this $10,000 investment. Now we'll see if they compound to that extent, but that's what I'm hoping for. And even if it falls slightly short of that, I should still be in a good position on this one. The second stock I've been buying to try to diversify my portfolio a bit as of recent has really been Realty Income Corp. So Realty Income Corp, very similar story as Coca-Cola. I bought it at a similar time. I have 140 shares in this one, so about $8,800. This one's paying me a 4.8% dividend yield. It trades at about a 15-ish multiple in terms of funds from operations multiple, which is kind of like the EPS proxy for a real estate or utility company. So definitely as I compare it to my Canadian retail REITs, I'm paying a premium for this. Lots of my retail REITs in Canada you can get for like 12 times, 12 and a half times. RioCan recently traded at 11 times. So paying a bit of a premium, but some of the things I love about this company here is just their diversification across the US. So all my REITs are pretty much entirely in Canada with the exception of Northwest Healthcare, which hasn't performed well recently, but they own hospitals all over the world. But I really like the US exposure here, every single state. And then I also like their push into Europe here. They bought some properties in Italy. They own some properties in Spain. You can see they have about 7-8% of their business, 10% of their business in the UK. So I love the diversification that this provides my REIT holdings, my real estate holdings in my stock portfolio. And, hedges me a bit out of Canada and then also a tiny bit into Europe with about 15 or 12, 13% of the rent. And that may grow with time as well. So really like that aspect of that position, like the starting yield at close to 5% as well. That helps me just like enhance my monthly dividends I'm getting in my US account. And then similar to some of the Canadian REITs, I think they have pretty safe allocation of retailers and tenants here. Lots of Dollar General, Walmart, Costco, Sam's Club, 7-Elevens, FedEx Distribution Center. A lot of really good businesses and partners. They work on triple net leases. So pretty straightforward business in terms of just getting checks every month, getting cash flow in every month, paying the dividend, and then using the excess capital for new acquisitions, paying down debt, increasing dividend, whatever it may be. And the last thing is I love how they do increase their dividend, usually on a quarterly basis, not even on an annual basis. Now, the increases are very small, sometimes not even 1%, but I like to see that income tick up quarter after quarter, even if it's slight in nature. They've kind of been under pressure to defend their tenants lately, so this is an interesting chart that they've done just to kind of show which one of their tenants kind of play in that lower price point, more recessionary defensive area, non-discretionary, and then more service oriented. They're kind of just showing how well positioned they are with their top 20 tenants here. So I just found that interesting as well. Not that that's necessarily the reason I bought the company. It's probably more along the lines of this, paired with the reasonable valuation, and them having a really strong position in a really developed market that I wasn't overly invested in the real estate in. So that was my second buy. So those two together were pretty big buys, collectively almost 20,000 US dollars, which once I do the exchange on that, those two stocks are now over 10% of my total Wealthsimple portfolio here. The last stock that I've been buying for some global diversification has been ZDI. Now, ZDI is a international dividend ETF. It's bought in Canadian dollars, so it trades on the TSX. It's a couple things I like about this stock, a couple things I don't. In terms of what I like, I think they have great international exposure. So they have stocks from Japan, blue chip stocks from Japan, Australia, Germany, UK, all over Europe. Think Italy, France, etc. So I love their exposure to Europe, to Australia, to Japan. Really gives you a good breadth of demographics to own blue chip dividend stocks. And they've also increased the dividend over the time I've owned the stock. So it looks like they're not just like yield, going for yield, they're also going for long-term dividend growth, which is great. You get a starting yield of about 4% here. Now, the stock's really run, it crashed initially based off of all the things that were going on in the European economy and with Russia and Ukraine. So I actually got in a lot in the $17, $18 range. It's run up a bit now, back up to about $22. So the valuation has definitely built up a bit. The other thing is the management fee on this one's about 0.5%, give or take, I think, which, for a REIT that's, for an ETF that's not a cover call ETF, probably, a bit on the higher side for my liking. So that's another watch out when you're buying these ETFs. You're getting a great product, good diversification, can sleep well at night with the basket of stocks, but you are paying 0.5% a year, which if you compound that over 5, 10, 20 years really adds up. And that's the main reason I've been managing my own stocks, because in addition to liking and knowing what I own, you also alleviate that compounding of management fee in the process. So that's the three stocks: ZDI, Realty, Income, and Coca-Cola. I've been buying to try to globalize my portfolio a bit. Cash is the stock I've been buying just to build up a bit of a war chest since the market's been doing pretty well. Other than that, I've been pretty quiet. Lots of my stock positions have been holding or going up even, the ones I'm interested in. A&W Royalty was one earlier in the summer. I was really interested in building to 525 shares. That gets it to paying me over $1,000 a year in dividends. As I look through my portfolio for other things I think are at a good value, I think Bank of Nova Scotia at $65 is a really good value. But my favorite bank in Canada remains TD Bank. I think it's a bit higher quality, so I'm paying a bit more of a premium. This one's trading at about 10 times earnings. Bank of Nova Scotia is like 8 to 9. But I do like the position there, and especially with their cash hoard after that first Horizon deal didn't go through. So have one eye on banking. Rogers Communication is one that recently merged with Shaw. So I really just want to see a couple quarters of how that acquisition impacts the financials, the EPS, the debt, everything like that, and how they're operating before going into this one anymore. But that'll be one that I may evaluate later on as well. But overall, it's not too much that's tempting me nowadays. It's really cash, which I got to the cash position I wanted, so met that short-term objective. But just trying to further globalize my portfolio in my USD stocks through stocks that fair values that give me exposure or more exposure in geographies I don't currently have. So that's it for today's video. If you like this type of content, be sure to subscribe to my channel, like this video for more. It really does help me with the YouTube algorithm, being such a small channel. When people do give these videos a thumbs up, let me know in the comments what you guys are doing in your portfolios right now. It's a really interesting time in the market. The market's run up a bit. No one exactly knows what's happening with interest rates, but they remain pretty high. So are you just hoarding onto a bit more cash than usual? Are you investing heavily? Is there any sector that you're really interested in? Would love to hear from you in the comments as well. So thank you guys again for watching, and I'll see you guys in the next one.